It's 7:14 in the morning. You haven't had coffee yet. But before your feet even hit the floor, your phone is already in your hand. Markets opened in Asia. Something happened overnight. Oil prices moved. Someone on CNBC said a word that sounded like recession. Your stomach tightens, just a little. You tell yourself you're just staying informed. You scroll for another 12 minutes. By the time you put the phone down, you feel vaguely anxious. And you're not even sure why. If that sounds familiar, this video is for you. Because here's the thing nobody tells you when you start paying attention to money. Following financial news every single day might actually be making you worse at managing it. Not a little worse. Measurably, provably, historically worse. And in the next 10 minutes, I'm going to show you exactly why and what to do instead. But first, let's talk about the notification. That ping you heard this morning, that little buzz of breaking news. There's an entire machine built to make sure you feel like you cannot miss it. This is the part nobody says out loud. The financial media's job is not to make you a better investor. Their job is to keep you watching. Fear does that. Urgency does that. The possibility that you might be missing something crucial. That does that better than almost anything else. According to analysts at Kane Asset Management, financial media is specifically built to bombard us with attention-grabbing headlines designed to play upon human emotions, because fear and excitement sell airtime, and they're very, very good at it. Here's an analogy. Imagine you have a garden. You planted seeds a few months ago, slow-growing, steady things. Now, imagine that every single morning, someone knocks on your door and tells you the exact temperature of the soil. Clouds are moving in from the west. A neighbor 2 streets over just watered their roses. A famous gardener on television says it might frost in December. Every day, new data, new analysis, new urgent warnings about your garden's future. Would any of that make your plants grow faster? Or would you just spend more time worrying and less time actually tending? Markets are a lot like that garden. Researchers studying investor behavior have found something they call myopic loss aversion, a term that basically means the more often you look at your investments, the more losses you'll see, and the more those losses will hurt you emotionally. Here's a number that should stop you cold. Historically, the S&P 500 has been negative on roughly 49% of individual trade-in days. Almost half. If you check the market every day, you are sad about half the time, even in a year where the market is up significantly overall. But zoom out to a 15-year window, and the odds of seeing a loss drop to less than 1%. Same market, same returns, completely different emotional experience, just based on how often you look. That's not a small thing. That's the whole game. Let's follow 3 different people through the same year. The first person, call her Maya, checks the news every morning. She has alerts on her phone. She watches the opening bell. By February, after 2 down weeks in a row and 3 separate segments about growing recession fears, she moves 1/3 of her portfolio to cash. She tells herself she'll get back in when things stabilize. They never feel stable enough. She misses most of the recovery. The second person, call him Daniel, follows financial Twitter obsessively. He's in several Reddit communities. In early spring, everything he reads is screaming about a hot sector. His feed is unanimous. He shifts his money toward it. It peaks 2 weeks after he buys in, then slowly bleeds. He holds too long because the same feed that told him to buy keeps telling him it will bounce back. The third person, call her Layla, checks her portfolio once a month. She reads a weekly summary on Sunday mornings with her coffee. She doesn't watch cable news. She made a plan 18 months ago with a financial advisor and only revisits it twice a year. At the end of the 12 months, her returns are the best of the 3, not because she's smarter, but because she got out of her own way. This isn't a coincidence. DALBAR, a financial research firm, has studied investor behavior for decades, and the data consistently shows that the average retail investor dramatically underperforms the market, not because of bad luck, but because of impulsive decisions driven largely by news cycles and emotional timing. The problem isn't the market, it's the reaction to the noise around the market. If this is opening your mind, hit like and subscribe. Here's the surprising reversal at the center of all this. Most people assume that following financial news every day makes them more informed, more prepared, safer. But according to research published in Investopedia on information overload, there is actually a clear optimum amount of information an investor can usefully process. And beyond that point, more data doesn't improve decisions. It creates confusion. It creates overconfidence in shallow knowledge. And it creates the illusion of control, which is perhaps the most dangerous thing of all. One analysis estimated that engaging with financial news daily is roughly 90% noise and only 10% signal. 90%. Think about that the next time an alert buzzes your wrist. The signal, the genuinely important information, might be a major interest rate shift, or a company restructuring in a fundamental way, or a geopolitical event with real long-term consequences. The noise is everything else, and the noise is loud. A researcher from the University of Colorado recently highlighted the growing threat of misinformation, specifically in financial markets, noting that misleading stories, including recycled old headlines, can manipulate stock prices and cause real damage to investors who react before they reflect. A survey found that 34% of young investors admitted acting on financial information from social media that turned out to be false or misleading. 1 in 3. And that was just the people willing to admit it. This is the other part nobody says out loud. The daily news habit is exhausting in ways that cost you money. A study cited in Livewire markets found that overconsumption of news contributes to stress, anxiety, sleep disruption, and chronic cognitive fatigue, all of which impair your ability to make good decisions. Your brain, unkept in a state of near constant low-level alertness by financial headlines, is not the same brain that makes calm, rational, long-horizon choices. One analyst described daily financial news as financial junk food, addictive, fast, satisfying in the moment, but ultimately leaving you less healthy than before. So what do you actually do? You don't have to go live off the grid. You don't have to throw your phone into a lake. What you need is a media diet, thoughtful, curated, deliberate. The same way a healthy person doesn't never eat sugar, but doesn't eat it every morning at 7 a.m., while their cortisol's already spiking. Start with a plan, not a portfolio, a plan. An actual written document that says, here is my goal, here is my timeline, here is my allocation. And here's the specific kind of news that would actually change any of that. Once you have that anchor, most of what crosses your feed will be immediately recognizable for what it is: irrelevant. Because a good plan isn't disrupted by a pundit's Monday prediction. It's disrupted by actual material changes in your financial world, and those are rare. Then limit your intake, not eliminate, limit. One financial advisor captured it well in advice published by WTOP News. Make a plan, consult on it carefully, and then stick to that plan no matter what is happening on any given Tuesday morning. Not every Tuesday. All of them. A weekly summary from a serious publication, the Wall Street Journal's weekend edition, Barron's The Financial Times, will give you everything you actually need and almost none of what you don't. Learn to ask one question about every piece of news you encounter. Will I care about this in 12 months? If the honest answer is no, and it usually is, you have your answer. Morgan Housel, one of the most thoughtful writers in personal finance, talks about the difference between expiring knowledge and lasting knowledge. Expiring knowledge is today's headline. It's technically true right now, but irrelevant by next month. Lasting knowledge is understanding how businesses grow, how markets cycle, what diversification actually means, why time in the market consistently beats timing the market. The more you invest in lasting knowledge and the less you spend on expiring headlines, the better investor you become, not because you know more, but because you know the right things. And there's one more tool worth mentioning: automation. A well-designed automatic investment plan, even just a recurring contribution to a diversified index fund, means you're investing steadily regardless of what the news cycle is doing. It removes you from the equation on the days when the equation is most emotionally charged. It is one of the most boring things you can do with money, and historically, one of the most effective. There's a famous observation, often attributed to Paul Samuelson, the Nobel Prize-winning economist, that investing should feel about as exciting as watching paint dry. If it feels like a thriller, something is probably wrong. The notification will keep coming. The ticker will keep scrolling. Someone, somewhere, will always be telling you that now is the most critical moment in the history of financial markets, and you must act immediately. You don't have to. Your garden doesn't need you to check the soil temperature twice an hour. It needs good seeds, enough water, and time. More time than any news cycle will ever give you credit for. One question before you go, and I genuinely want to know: have you ever made a financial decision based on news or social media that you later regretted? What happened? Leave it in the comments, because the more honest we all get about this, the better equipped everyone here becomes. If this video changed how you think about the noise around your money, subscribe, because that's what this channel is: calm, clear thinking about financial life without the drama.